Whole life insurance is a wildly misunderstood product. While financial entertainers like Dave Ramsey and Susie Orman have railed against whole life insurance for decades because of their stance that whole life insurance is simply a terrible investment, there are now licensed agents on the other side of the spectrum trying to convince people that life insurance is actually the secret tool the wealthy use to get rich. The question is, what's the truth? What role should whole life insurance, or any life insurance product for that matter, play in your personal finances? Let's take it step by step. Whole life insurance will not make you wealthy. It might make your family wealthy if you die too early, but not you. Second, whole life insurance is not an investment. Life insurance companies are not and should never be seen as investment alternatives. This entire talking point is being skewed by thousands of TikTokers, Instagrammers, and YouTubers that are advocating for index universal life insurance being a better alternative to qualified accounts like 401ks and IRAs. Unfortunately, there's simply no factual evidence of IUL having success in the long term. While many people will advocate for life insurance retirement plans, or LIRPs, utilizing IUL, the product is still in its infancy, and while it's sold as a simplistic solution to your financial goals, I promise you it's a highly complex product and strategy that the majority of the time has let people down over its history. Don't shoot the messenger here, I'm just speaking facts. And even when it's properly structured with a minimum death benefit and maximum cash value and funded to the guideline level premium, IUL is far more risky than the IUL agent hawking the product to you will tell you that it is. My brief advice on IUL is that you should read every single line on the IUL illustration and take all the warnings and the disclaimers seriously. There are more lawsuits settled and sealed in arbitration for IUL than any other product in the insurance business. It's the dirty little secret of the industry. Pac Life is involved in a lawsuit right now. They tried to have it thrown out of court based on the fact that they have these illustrations, but at this point, the judge has actually denied the request. It's actually pretty sad to me that so many people are getting caught into the hype. Life insurance companies have never been good at generating high returns for their clients. It's just not what they do. What life insurance companies do best is get you the best possible return with the lowest risk possible. The problem is, when you use an IUL over a whole life insurance policy, you take the ability away from the company to get you those safe returns, and you speculate with options and inject risk into a situation that shouldn't be risky. So why am I talking about IUL in a whole Life for Dummies video? Because if you're looking to utilize life insurance as an asset at all, you're bound to run into someone trying to sell you IUL as a new enhanced version of whole life insurance. So at the end of the day, I just at least wanted to give you the basic. Now, I'm never gonna tell you to not explore Index Universal Life if that's what you want to do. Once again, read every single line of the illustration of both your whole life and IUL illustrations and draw your own conclusions. For that matter, I want to double down on this. Be sure to read every line of a whole life illustration as well. You should never put your money into anything that you don't understand. The way I see it, education is empowerment. Okay, so thus far, I've told you what whole life insurance is not. It won't make you rich, and it's not a great investment. So far, it's not a resounding review, right? So why is it that I love whole life insurance so much? Let's get into it now. First, whole life insurance is an enhanced storage place for capital. I talk a lot about financial structure, and I have a thing called the hierarchy of financial needs that we teach at Life 180. I think the financial foundation to your life needs to be set up so you have all the safe money, your emergency fund, an opportunity fund, and you make sure you build on top of that. The biggest risk is that you go out and you take too much risk too early and you don't implement compounding in your life. The way I like to describe it is simply like this. Whole life insurance provides bond-like returns, municipal bond-like tax treatment, and money market-like liquidity. It's going to protect you against emergency, and it's going to put you in a position to take advantage of opportunity as you go throughout your financial life. Second, whole life insurance provides living benefits through accelerated death benefit riders. If you become critically, chronically, or terminally ill, you can access your death benefit while you're alive. Some carriers even have the ability to add on long-term care riders, or you can utilize the accelerated death benefit riders as a long-term care alternative. Just be careful and understand that it's not, most of the time, a pure long-term care insurance coverage. Third, whole life insurance provides even more living benefits. I said before, bond alternative, bond-like returns. When you utilize whole life insurance as part of your financial strategy, it can provide volatility buffer during retirement. I'll explain that later. But it gives you liquidity for opportunity. It also gives you creditor protection in most states, which is a huge deal if you're a real estate investor or an entrepreneur. So before I go any further, I want to talk about a key point. I want to walk you through the process of what I think you should do if you're looking to get a whole life insurance policy right now. First, determine your future net worth. Here's a simple formula that the life insurance companies use most of the time. Annual income times 20 equals your potential net worth. Example, if you make $100,000 a year and you multiply that by 20, that's $2 million. This is how the insurance company determines what they call your human life value. And it determines how much the insurance company is going to qualify you for. My advice is to maximize this amount. You may not be able to afford the entire premium for that life insurance amount in whole life insurance, but I'll address that in a moment as well. Second, determine your monthly or annual free and clear cash flow, whichever one you focus on how you pay your bills. Third, get a convertible term insurance quote for your potential future net worth, $2 million in this example. By using convertible term insurance, you're ensuring your ability to get life insurance is locked in. You're making sure if anything happens to you in the short run, your goals are protected with life insurance coverage. At the same time, you're working to improve your financial efficiency by eliminating debts and freeing up more cash flow. If you have debts, make sure that you use additional free and clear cash flow that's in excess of your convertible term premium and use it to accelerate the pay down of your toxic debts. Once those debts are paid and the cash flow in your life is increased, you can convert the term insurance into a properly designed whole life insurance policy and begin using the banking alternative strategy that we utilize with whole life and cash flow investing strategies that I coach people to. If you don't have any debts, you can begin using free and clear cash flow to start saving money in a whole life insurance policy right now. Remember, whole life insurance is not an investment. I'm going to say it again. It is a savings alternative, an enhanced savings account with additional benefits. Fifth, if you have money sitting in a savings account currently, my suggestion is to determine first what you can afford on an annual basis to save inside of a whole life insurance policy, and then optimize to front load that money into the policy from your savings account. This will supercharge the efficiency of the policy, and it will help increase your cash value growth sooner. Sixth, focus on hitting benchmarks. At the end of the day, you can't draw blood from a rock. The amount that you're able to save will determine how fast you'll reach your objective. But there are several benchmarks that I encourage everyone to reach. The first benchmark is have 6 months of income in cash value. This will provide a bit of a safety net for you and your family. It's the beginning of your savings account and it will operate as your emergency fund. Second benchmark, having 12 months of income in cash value. At this point, you'll have the ability to start entertaining different opportunities for investment in real estate, in businesses, or whatever you think, maybe private money lending or something of that nature, whatever your skills are. The third benchmark is 2 years of income of cash value in your whole life policy. Once you have 2 years of income in cash value, now you have a true opportunity fund. No matter what is happening in the economy, you have enough savings to take care of your emergencies and be able to search the market for opportunities when the opportunities are at their greatest. Make money while there's blood in the streets, as Warren Buffett would say. The fourth benchmark is having 5 to 7 years of cash value inside of your whole life policy. When you hit retirement, your whole life cash value will transition from being an emergency and opportunity fund to a volatility buffer and a bond alternative for your retirement plan. Let's face it, if you're going to retire at 62, there's a good chance that you're going to live over 30 years in retirement. That's not my opinion, it's just statistics. That said, if you live 30 years with no income, you better have a plan to weather the financial storms that are inevitable during that time. Having 5 to 7 years worth of income in a whole life policy allows you to use it as a volatility buffer, drawing tax-free income from your policy on down years. This allows the investment portion of your portfolio to recover and ultimately will increase the efficiency of your entire retirement plan significantly. The fifth benchmark I focus on is leaving the legacy that you want to leave on a guaranteed basis. The power of using whole life insurance in this way is that it guarantees that what you want to happen will happen when you want it to happen, whether you're here to see it or not. That's why the only way to optimize your financial strategy, if you care about leaving a legacy, is with a properly designed whole life insurance policy. The key point here is that it needs to be properly designed to meet your short and long-term goals. Make sure you meet with somebody that understands what that means for you. If you'd like to have a conversation about how whole life insurance could work to help you reach your personal financial goals, make sure you reach out using the link in the description below. We'd be happy to help you set up a clarity call and give you some guidance in this process. Be sure to leave a comment in the comment section below, like the video, share the video, get it out there to people. If you have any questions at all, comment or reach out. It's what I love to do. I'm here and I'm happy to help. Have a blessed, inspirational day. We'll talk soon.